I'm apologizing. I'm eating my lunch. Y'all, this is the greatest thing known to man. I've been eating this since I was a kid. My mama was never much of a cook, so she'd buy this and she'd heat it up. And then one day I opened the can and I was like, I was just gonna eat it raw, right? The Chef Boyardee spaghetti meatballs. And I go, this stuff is better like just room temperature, like right out of the can rather than being cooked. Oh, and my sister and I used to fight over the meatballs. So now I have to hide this from my kids, or they eat it straight out of the can just like I do. Oh, I probably got stuff all over my mouth and stuff. But it's what a little treat that is. It's really good. And thanks to Ken um, for leading the sessions last week. Enrico, first time here. How about that? Well, you picked a great day to be here, because when I get back from vacation, you've seen that little cartoon, where the husband and wife are sitting on the beach. She's dreaming about them holding hands, walking down on the sand, and all of a sudden in his little dream cloud, he's thinking about markets, right? That's kind of the way I am on vacation. So the kids may be in the pool, and we may all be in the pool or the hot tub or whatever, walking on the beach, but I got markets in my head. It's just a curse, I guess. It's one of those things that we do. But I had some epiphanies, I think, and I always come back with cool stuff after I get on vacation. I told my class at Alabama, I said, look, y'all need to, when y'all get into the working thing, y'all need to take 4 vacations a year. What if they only give you 1? Well, you need to find a job where you take 4. Or do it after work, right? I mean, go to work and then spend some time with your friends or family afterwards. But it's just, you got to get away. Just got to get away. And it's really good to, I try to take 4 a year to where we just, people when I'm back working, they say, God, you're on vacation all the time. Exactly. I go 3 months working, 1 week off. 3 months working, 1 week off. So it really does make you feel good. Y'all see my tropical tan I got? I stayed in the shade when possible. Fat people and sun just do not mix. I mean, it's just like, all that blob just sweating all over the place. It's just not fun. All right. I'm almost scared to tell y'all what I came up with while I was gone, though, because I'm afraid some of y'all might actually try this. And I don't know if I want you to try it. So if you try it, I mean, this is one of those things you could go, man, I might can blow out on the count or something. I don't know. We'll talk about it. But I want to talk about what my epiphany was on vacation. If that's how you say that word, that's a big word, epiphany. But let's talk about the market first. So the market is up 0.24%, blah, blah, blah. Where's my little pointer thingy, Bob? There we go. So AD is 58. So, it's doing what it's doing. AD just kicking out here. Advance over decline, but it is positive. The opening 15-minute session is here in gray. Notice that the overnight low is also at the bottom of the opening 15-minute session. So 36 to 52 or 53, how much is that? 36, 4, 13, 17 maybe. 17-point opening range. This little white line is the cash open, so it was, kind of cool. We're above the VWAP and we're above the hourly midband. It's very, very cool. Here's the overnight high. We've now taken out the overnight high. So what do we think? Just a regular old day, and not much action going on last week too. I did a lot of trading though. I did a lot of stuff. I did a lot of cleaning up, but I'll tell you why I did it in a little bit. All right, so from here, let's look at our great chart that tells us what the market's going to do, and that is our volume profile. Volume profile, where we get the green monster and volume profile all in one. And look at these. We're above the 20, the 50, and the 200 period moving averages. We went from a gap opening. Matt, what does that look like to you? That looks like a gap open. And
Trend day.
Trend day, right? Kind of looks like that today, except for that weird candle there. Gap open, gap fill. Nope, gap never filled. Maybe another trend day. So this period, so this is fair value. This is overbought. So now we're in oversold, and now we are climbing up to the new fair value range, which is up here somewhere. Where's it? Up here into this fair value range. All right, where's price likely to go? Well, it's either going to go here or here. We don't know, right? But we got another little tool that really kind of helps us to determine market direction, and that's our screwdriver. Bring our screwdriver down. Our screwdriver says, let's see, 32 days out's where I went. 5.2 is at 42, right? So let's see if we can, and I didn't update this all last week, so I'm way behind. Oh, well, I'm not behind. I'll just start it from today. 10. Wait a minute, this isn't even the one that updates, is it? No, man. Doodle. Well, anyway, I fixed one where it, I think I may have it on Google Drive or something. I'll fix it. So, but if we're at 40, what was it, 42, that's getting closer to the average, right? So that kind of tells me that if anything, I think we'll probably go up a little bit in the market. So I'm thinking the market is fairly priced and going upward into here. I think based on the screwdriver that there's more likelihood that we're going up into here in the coming days than we are going down into here. But of course, I don't know because we are fairly priced and the screwdriver's at 42. Well, what's the normal screwdriver? 25 to 35. So we're a little out of normalcy. So if the screwdriver is to normalize, that means we're probably going sideways to up a little bit. Now, so that's kind of my market opinion, my market direction, blah, 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 blah. All right, now hold on to your seatbelts because here's where it gets fun. So I've been doing back testing and it is manual. And what I did is I back tested from the inception of TQQQ. Everybody knows what TQQQ is, right? It is the 3-time leveraged of the Qs, right, of the NASDAQ. Now, if you go and look at anything on the TQQQ, remember I made this part of our AIM system that we were trading. It did really good. In fact, matter of fact, let's see how I'm just going to show y'all. It's one of my biggest winners. Let's see, 17. Where does it show that? Here, TQQQ. I'm up 2109.90 something, 2114.71 on the year. And you see, I'm really doing good in the micros. The micros are just split up, right? 27 up 1500, up 1400 there. So, you know, I was already profitable on it. And then I get to reading too much. I get to read. And everybody and their mama says you cannot hold TQQ long term. You just can't do it. It will kill you. The moves are horrible. What's this? TQQ as a long-term investment. You start Googling this and people will talk to you about the decay, the volatility decay, and how horrible it is, and how, you know, if you're going to work with this TQQ, you're going to, you know, run out of money and you're going to blow your account. And I thought, well, if the crowd is telling me I can't do something, that makes me want to do it. So I started back testing something. Let me just show you what I started. Now you'll say, Bobby, on vacation, this is as far as you got back testing. And I'll say, yeah, but I had to start over a couple of times because I had to tweak formulas. I had to do, if I found out something wasn't working right, then I'd go back and tweak something the way that things were going, right? So let's look at this. So if on February 11th, 2010, we started out with $50,000. This is when TQQ was first introduced. And we ran it every month. Notice I'm updating my net lick every month. 211, 311, 412, 512, 611, 711, whenever the trade day is. So I'm going out every month. And what I did in this account is I assumed that I put 40% into TQQQ. Okay. So the split adjusted share price on the day that I started was 87 cents. So I put in $40,000, $39,999.99 into it. Now you see it's had some big monthly swings, right? The first one we were down 5, you're down $10,000 instantly. No. I'm not thinking that's not the net lick. Go back to net lick file. It's been a while. You're not up. You're up 10,000. You're up 15. Oh crap, you're down 4 there, but you're still up 11. Oh crap, you're up 4 only, but you were down 6. So this is a volatile instrument. If what they attempt to do is if the QQQ, NASDAQ 100 is up 1%, then this thing tries to go up 3%. If NASDAQ is down 1%, then this thing theoretically is down 3% or 3 times as much. Okay, so you got to know how this thing flows. But I said, what if we put this in the AIM little deal? How would it perform? How would this do? And that's what I did. I put 40% in this, and I kept 20% in cash. Okay, so that's probably aggressive, right? But that was Robert Lucello's thing. You know, he started out, he said, you know, keep 50% in stocks, 50% in cash. Started out that way. But I went, you know, 80% and did this. Now, I did no annual rebalancing either. I did not rebalance annually. Didn't do anything of that. Just kind of said, I'm just going to see how it goes. So here's how it goes. I want you to see the actual returns here, okay? So just kind of watch this. So far, I've taken it, you know, here we're up. We're never down money, okay? But we did have some wild, you know, monthly profits of down 9,000, down 12,000. That's why I said, God, I don't even want to bring this up to you. But I thought it's very interesting. If you have a pool of money that you would like to, you know, go to the casino on, let's say you got $10,000 and you want a weekend at the casino. I would rather run this than take my 10,000 to the casino. So put 8,000 in the TQQQ, keep 20% in cash, and let it ride, baby. And then let AIM make your daily decisions for you. So I want you to keep watching here. So it kind of goes up, right? We finished 2010. We started in February, so we finished 2010 up 57%. Ta-da! It's pretty darn good, right? So then we go through 2011. How do we finish 2011? We finished 2011 up 59%. Uh-oh. That's not too good, right? So if we finish 2010 at 57%, so we didn't do too good in 2000. Let me make sure I got 57% here. So we're up at the end of 2011, 59%. So you didn't do too well in 2011, right? Kind of a stagnant year. All right, so keep on going a little bit. So 2012, you're up, in 2012, you're up 107%. So that's the year 2010, 2011, 2012. So you're what, over 33, 34, 5% per year. Not bad, right? But then you say, you go, so let's see how we go after 2013. 2013, we're up 190%. Ta-da! It's pretty darn sweet, right? So notice we don't have any big, humongous drop downs there. I know it's a bull market, blah, 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 blah. So now I've got up to, oh, my dogs are home. Beth just picked up my dogs. Come here, Sadie. Come here, Roxy. Come here, babies. I hadn't seen them all week. Hey, darling. Hey, you missed your daddy? You think daddy wasn't coming home? Devils, you. Look at my baby. Sadie. Y'all about that. We had them. Dang it. They stay, y'all stay together in a cage, and y'all gonna get out and fuss like this. Unbelievable. Oh, you hit me in the head. Save me a lot of money because they got to stay in one cage. All right, y'all quit fighting. I know y'all just showing off because you play CJ. Oh, I love my little baby. All right, what were we talking about? So we're up 227% here, y'all. That's pretty good, right? Our running P&L is $113,000. Now, here's the interesting part. What I probably should have done in hindsight is went much more conservative. I should have done, your breast things. Good Lord. What did they feed you? Get in. What I probably should have done is started out with 50% of TQQQ and 50% cash. And then at the end of each year, I should, you know, rebalance. So go back to 50%, 50%. That's probably what I should do. And I don't know if I want to start the back test over. If y'all want to help me back test this, oh my gosh, it would be great. I wish somebody could help me figure out how to back test this really, really fast, but I'm just having to go in, see what the price was at the end of the day, make the trade, blah, blah, blah. So it's really been hard. But look at this, y'all, 227. Now, here's what I want to show you. I didn't rebalance, right? So how many shares am I actually holding? So I start out with 45,977 shares of TQQ at 87 cents a share. So how many am I holding now? Well, you see, I dropped shares, I sold shares, sold, bought some, bought some, bought some. So you buy when things go down and you sell when things go up, right? So if I started with 45,977, now through August 14th, how much do I own? Started out with 46,000. Check this out. I only own 7,301 shares. Wait a minute. So wait a minute, Bobby, you're telling me that you started out with 45,000, but you didn't rebalance or anything. So at the end or close to the end of 2014, you only own 7,300 shares at $7.46 a share for $54,000. You're telling me, Bobby, that you are holding $109,000 in cash? Cash? And you're up 207%, 227%. Yeah, that's what I'm telling you. Y'all, do you see how powerful that is? What? So now I'm holding $54,000 in stock. I'm holding $109,000 in non-productive cash. I'm 67% cash. I'm 33% stock. And I'm still at a $227.40 return. Y'all, is that sweet or what? That is the power of this little AIM system. Now, I gotta tell you some tweaks that I had to make, y'all. So do y'all remember in this formula that I put a governor in there, right? I put a governor in here that says slow me down on buys and slow me down on sales. Forget it. Forget it. I don't want you to use the governor. I want you to come over here and always keep it at the 0.1. Don't go up to 0.15. Don't go up to 0.2, 0.25, 0.3. Keep it 0.1. So what I had to do is come back here in the formula. Let me show you all the stuff. And this is going to sound real complicated. And I can walk y'all through it if y'all want to do a little individual session or something. So you got to remember, some of y'all have not read Lucello's book, and you need to because it'll make sense. But Robert Lucello says safe is basically 10% of your stock. So what we were doing is your formula on your spreadsheet says AIM activity M2 times D2. You need to change that. I would change that to say AIM activity L2, which is this number, L2, instead of M2. Don't use the governor. Don't use the governor. The governor, don't use it. Use this. I was not satisfied with what this did. It attempts to slow you down on the bottom and when you're buying, and slow you down on the top when you sell. Don't use it. I'm gonna still look at it. I still want to look at what my streaks are and everything. Don't use it. Don't dang use it. All right. So let's go back. So if you've got my little spreadsheet, you need to go over here and you need to change H2 to L2. Okay, L2. And keep it there. So that's what it does. So let me hide these again. Portfolio control, buy, sell, action, not amount. Hide all those. I'll look at this and I go, how did I do this? I don't know. I must have been on medications or something coming up with these formulas, but they are horrific. I was looking at them going, gobble. I don't know. But could you imagine So now you're sitting there going, are you scared that you hold 7,000 shares of TQQQ at 746? Bobby, what if the Qs are down 33% and you lose 99% of your value and this goes to zero? Well, do you really care when you're holding $109,000 in cash? And you see the power of it, right? So we started off with a $50,000 account. We started off with $40,000 of this stock. Well, now we've got $54,000 of that stock, but we're holding $109,000 of cash. Our cash balance went from 10,000 all the way up to 109,000. Now, there are those among us that will say, yes, Bobby, but you can't do this. You can't do this. The TQQQs will kill you. They'll put you out of business, blah, 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 blah. I understand that. If you are a buy and holder, I would agree. If you are a buy and holder, I'm going to agree, right? Because you never know when that could go down. We're not buying holders. We're using a algorithm that was developed by Robert Michello that I have brilliantly placed into an Excel spreadsheet to tell us when to buy additional shares or to sell additional shares. So a much less risky way to run this would be to put 50% of your portfolio into TQQQ, leave 50% in cash, rebalance annually. So that if in a $50,000 account, your maximum loss in TQQQ is $25,000. God, Bobby, that's 50% of my account. I got it. I got it. I'm with you totally. I thought the math suggested the system was self-governing. So I think this is self-governing. I think this little thing here where it tells us what to do is self-governing. It tells us what to do, y'all. Now here, normally the price of TQQQs is pulled in from, I'm having to put it in manually. I wish I could show you how I'm doing this. But here's what I also want to show you, because I spent some time on this. And let's see if I can find this for you. Have any of you used Portfolio Visualizer? Y'all use that? It's kind of cool, right? So let's see how I got to it here. So let's back test a portfolio. All right, so this started in 2010, right? 2010 is when we got TQQQ. Through end date of, let's say 2014, because that's where I'm about right now, right? So we started out, let's say you started out with, let's say 40,000. That's how much I bought, right? So we bought $40,000 of the stuff. Now, there's a chance that this may have done better than we did. I just want to say this, rebalance annually. Well, we didn't, so let's don't do any rebalance. Okay. So we start out with $40,000 and let's go TQQQ. Portfolio 1. Well, I guess I could do the same thing. I could go initial amount 50,000, and so we'll do the same thing. Let's say you go 80% there. And let's say we go cash. Let's see how this is. So if then this would just be buying and holding, right? So you go 2010, 2014. Be interested to see how this does. Now, keep in mind though, you're not selling any of your shares, you're holding them. So you may be up a lot more, maybe even more than we are. But guess what? You are taking on a lot more risk. Why? Because that 49,000 shares that we initially bought, you're still holding all 49,000. Seems kind of stupid, right? I mean, because if the market goes down 33%, then theoretically we're down, 99%. So let's see what happens. Ta-da! I love this little thing. Y'all, if y'all didn't play with this, this is just cool stuff, right? All right, so let's see where you are. So this is here's our little ticker. So we did 80% TQQQ, 20% cash. How did we do? Got a Sharpe ratio of over 1, got a Sortino ratio of over 2. That's kind of sweet. Your maximum drawdown was 29%. And it'll tell you where that happened, right? Your return is 44.99%, and your final balance is $220.96, 220967. Well, keep on mind, I'm only at October yet. So where am I at? Let's go back. Where am I? Just you and I. Just you and I. I'm at 163,000. I'm up 227%. But I only own, and now keep in mind, this portfolio, look at the risk that you got in this portfolio. In this portfolio, baby, you're 100, you've got 80% still in your thing. How much do I have? I have 30% in the stock. I am killing it in comparison to this. Well, what could I do with that cash? There's a lot of things I could do with it. I could sell options. I could do all this other kind of garbage, right? But this thing is brilliant, y'all. The thing is, now I like what else this thing does. Let's see. So this says, let's see, 3 months, you're up 12%. Let's see, portfolio one, you're up 53% after 1 year. What were we up after 1 year? Like 57 or so. Thank you, Chief. Where's my thingy? Here we go. What were we after 1 year? It's 2010. We were up 57%. But think about how much less risk. Do y'all see that? I mean, I hope everybody's saying this is, you're still 80% or not 80%. You still holding that 44,000 shares. So if we have a big old drop, I mean, you're going to lose a ton of money. Over here with AIM, we're sitting so pretty because we only are holding 33% in stock. We don't even hold 44,000. We're only holding 7,000 shares. Oh, that's good. Now let's see on this other one if rebalancing helps. Let's see if rebalancing helps. So here we're up to 229.67. What happens if we rebalance yearly? Rebalance annually. Now let's run this puppy. Ta-da! Look at there, 204,000. So actually on this one did better not to go up. But now let's see something else. Let's go with this. It's kind of cool. Let's don't rebalance again. And let's go through to 2021. Let's say we started when this thing started, and we go all the way through 2021. Now this is what I'm going to back test it, my little manual Lacello system. But let's just say include year to date. Yeah, let's do that. We want to see how it's done through October of whatever. No rebalancing, blah, 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 blah. So let's analyze portfolio. Let's see how we do. Okay, y'all. Stacy, this is going to make you kick yourself, right? So if we had put in $50,000 and $40,000 of that had been placed into TQQQ back in 2010, we would have averaged 47.46% return. Your $50,000 would be $3.2 million in, what is it, 11 years? Your best year was 131%. Your worst year was 19%. Your maximum drawdown, can you stomach a 48% drawdown? Your Sharpe ratio was over 1. That's good. Your Sortino was 1.9. That's good. Now, here's the cool thing, y'all. I mean, so, you know, there were years that you lost, but overall, you're averaging 47% return on TQQ. Now, that's just buy and hold. Now, keep in mind, I think we're going to do much better with the Lacello system, 50-50, maybe not 80-20, right? And then we'll annually rebalance to kick it back up. So, you know, that we'll hold more shares. So the most that you could ever lose, if the dang thing goes to 0, is 50% of your portfolio. Now, here's what I wanted to show you too. This thing is cool. Have y'all used Portfolio Visualizer? This thing is really, really awesome. So let's go back here. Let's see, there was something else I wanted to show you. Where's it at? Factor regression, fund, fact, where is it? Come on, portfolio optimization. This was really fun to play with. All right, so we'll go 2010 to 2021. We'll maximize our sharp. We want to maximize returns subject to a targeted volatility of 50%. So basically, losing up to 50% of your portfolio, right? All right, so let's go here and see if we can do this. So let's go TQQQ. There we go. We're going to do 80%. TQQQ. We're going to do cash. Now, here's the cool thing. You've got to put in another asset that is a risk asset, but I'm going to put it into 0. So it requires you. So if I ran it now, right, with 80 of this, it says you can't do it. Watch, it's going to give me an error. At least 2 risky assets are required for portfolio optimization. What this doesn't understand is that Joe Biden is president and that cash is a risky asset. Because we have inflation, as they say it in France, I guess. So I'm going to put UPRO here, 3x the S&P 500, but we're not going to put anything here, right? So it'll still run our portfolio. But the cool thing is this thing will actually maximize your portfolio. It'll show you how to maximize your return subject to a 50% annual volatility. So let's try this. Did I say annual rebalancing or no? Did it say, did it even ask me? All right, here, let's go amp to optimize this. Okay, so here's our portfolio, 80-20, right? So it comes back and says, hey, Bob, really, you need to put 100% allocation into TQQQ. Well, y'all, that is really, really kind of risky, right? But hey, if you're a holy roller and want to do it, go with it, baby. So we started off with $10,000 in my portfolio of the 80-20. And this thing came out with an ending balance of $420,000. A return of 41.67%. Best year was 103, negative 13%. Check it out, baby. We had a 40% drawdown. Now, this is not doing the Lucello system. This is just buying and holding, right? We're just buying and holding. So check it out. The Sharp, the Sortino, we've already looked at. So the provided portfolio was the blue portfolio that I put in. You see the drops, you see the volatility. I mean, but really, I mean, you start off kind of rough, but it's definitely in the right direction. So we go over here then, and it says, hey, Bob, you would get a maximum return if you'd put 100% of that, your $10,000 into TQQQ, and you would have got 810%. Your return will be 50.51%. Now check it out here. Your best year instead of 103% was 139. Your worst year was down 19 compared to the 50-50 or 80-20 portfolio of 1351. And instead of a 40% drawdown, you would have had a 49% drawdown. But the Sharp ratios and Sortinos remain the same. Okay. So everybody's following what we're saying here. So we're saying that we can long hold this puppy and obtain wonderful returns and do it much safer by using the Lucello little program. Now, Bobby, this is risky. What happens if the market tanks? Matt, what happens if the market tanks? What do we have? We've got Lucello telling us when to get out of this thing. Market tanks, we're going to load up and buy more shares of TQQQ. But what else do we have? Somebody tell me. Y'all been here a while. What did we have?
Yeah, baby.
What's that?
You got cash.
Yeah, we've got cash. And we've seen that the Lucello model has taken me from 80% stocks, 20% cash, to 33% stock and 67% cash. But we've got something even better. You and I.
Black swan hedge.
You damn right. We got the black swan freaking hedge. But Bobby, you're doing that in ES. Well, okay. That's the S&P 500. Is it highly core? And I even looked, y'all, at maybe doing a black swan hedge in the NASDAQ /NQ. I don't like it. I can't find out where we would do it. But this thing is close enough correlated to the NASDAQ that we're going to be protected on that downside here, right? So let's just look at single symbol. Let's see, hide simulation. All right, so here we go. Hey, baby, I'm so glad to see you. All right, so this is just my ES. So right now in this account, if the market goes down 20% and vol steps up like I think it would, to be at about 60 to 55%, we're up $141,000. We're up $141,000. Okay. So what happens with, let's say that this is down 20%. What happens if TQQQ is down 60%, right? Because it goes down 3 times as much. Well, let's just do this. Let's just do, we can't do a vol step on stocks. So let's just say, you know, expiration, so we can kind of see this, where this would be. So if we're down, I think I did my price slices here. Oh man, did I not save it? So let's just do it here. Let's say we're down 60% on my TQQ stuff. So let's say TQQ down 60%. I hope some of y'all's little things are going off in your head going, oh my gosh, hide simulation, so single symbol, so this should be my thing, right? Let's see if we can see that. So if we're down 60%, that's going to mean I'm down $19,000 on my TQQQ play. I find my price slices here. Helps me better when I see it. So that's going to be at 55.09. Let's see what that looks like. 55.09. Here we go. So this is with TQQQ being down 60%. I'm down $19,322. Okay. Well, hell, let's go bad. I mean, let's say, what if we're down 75% in this thing? Yeah, let's go 90%. What if we lose 90% value on this thing going down 90%? Okay, so my loss is 29,000. What if we're down 100%? I mean, TQQQ, as risky as everybody says it is, it can't go below 0. It just can't. You're owning an ETF, you know, you're like a stock. You can only lose what you got in it. So I could lose, you know, 32,900, well, 32,715 million. I'll lose my entire, you know, amount that I've got into it, right? At 100% down. Do I care? Oh my gosh, do I care? Now y'all see why I go on vacation? I don't care if TQQQ goes to 0. My God, Bobby. And what happens the whole time? Let's say TQQQ goes down. What am I doing? I'm accumulating shares all the way down on something that will inevitably go up. What do you think will be the greatest performing asset class in the next 10 to 20 years? I think it's still going to be technology. Yeah, Bob, but what happens if we have that big, you know, .com bust like we did in 1990? Praise the Lord. Because what will AIM tell us to do? AIM on the way down will tell us, bye, 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 baby. Bye, bye, bye. Let's get as many shares as we can. Let's create a TQQQ empire on something that you and I know is going to come back. So what am I saying? I'm saying this. And you probably heard me talk about this at some point because it was one of those things that was in the back of my mind, but I just hadn't had enough time. Fortunately, vacation gave me enough time to think, to sit on the beach and to relax and to put these things into a spreadsheet where I could look at it. But so what I'm saying is this: AIM. I got a pen. What am I doing there? AIM plus Black Swan hedge equals powerful, explosive returns. Now, y'all know I'm not the smartest, cat at the party. So I want you to attack this. I want you to tear this apart and tell me why it won't work. So the cool thing with this, I don't need to sell my micro puts anymore unless I want to, right? Because I've got a lot of positive delta by holding TQQQ, right? So I've got lots of delta, positive delta. So I think in this account, I've got 243 shares. I did it, y'all. I bought them. I think I bought them on Friday, maybe on Thursday. I bought 243 shares of TQQQ. When the world says you can't hold it long term, Bobby, it's got volatility decay. Okay, I'm with you. So my maximum loss is the 243 shares going to zero. That's a defined risk in my case, right? So defined risk. Now, let's say that you've got a $50,000 account and you don't want to put 80% into AIM. Well, could you do 10%? Could you do 20? Could you do 50? Would you be willing to go with 25 or 50%? Yeah, Bob, I'll put $40,000 account. I put 50% in. I will risk $20,000 with a Black Swan hedge and doing the AIM program on TQQQ. Now, why TQQQ? Why not UPRO? You could do it on UPRO, but what I found out was from the portfolio visualizer that, let's see, I thought they normally showed me the third portfolio, which was a 50-50 mix of everything. Anyway, if, for example, let's say that you were going to do this. Watch this. Let's say you go TQQQ 50% and you go UPRO 50%. The cool thing about this is the little thing will optimize it for you. So it'll say, okay, here's what your portfolio did. Okay. So your portfolio, little Bob, had a maximum drawdown of negative 54%. Can you stomach that? And you ended up with $429,000. But the wonderful thing that Portfolio Visualizer says, hey, Bob, there's even a stronger portfolio combo of the two, and the two is 100% TQQQ. See that? Because then you would have come up with 810,000. So the great part about this is we now can make this thing as risky as you want it. If you're starting out with $50,000, like I did in this account, you can say, well, I'm going to put 50% into TQQ, or I'm going to do 10%. You choose your amount of risk and let that puppy run, right? And now all of a sudden, from 2010 to 2014, you're up 227%. But you're no longer holding 80% of the stock. Y'all, how much better does this get? You're now holding, instead of 45,000 shares or whatever it was, You're only holding 7,301 shares. No wonder you're only up 220%, 227%. You probably, you fat son of a gun, Bob, you black glass wearing geek, you probably should have rebalanced at the end of every year to keep more shares of TQQQ, right? So now if my account is 171,000, I could go $85,000 in stock. Can you imagine how that's going to do when it goes up? Well, what's your maximum risk if you're holding $85,000 worth of TQQQ stock? It's 85,000. But you will already have cash that started out at 10,000. You'll have cash of 85,000 as well. So your cash balance went from 10,000 all the way up to 85,000. And you've got the black swan hedge that is going to protect us if the whole market just goes to crap. How's your black swan hedge looking today, Bob? Well, it's looking pretty darn good. Let's see. Let's go to it again. Do our little thing. Do a little fall steps. Put our fall steps in here. 20% down in the market. I'm up 140,000. Dang, that's terrible. But if you lose every bit on your TQQ stock, Bob, you just lost $40,000. I really don't care. Do I? Do I? Yes, MRP, the spreadsheet tells you when to sell and when to buy. So now you're sitting there going, wait a minute, Bobby, I thought you said a market correction is coming. I believe it is. But my maximum exposure is my $40,000 in the Qs, the TQQQs that I've now purchased. And if that were to happen, then I'm going to make between 98,000 and 141,000 on my hedge. Yeah, so MRP, let me just show you this. This is kind of cool because you may not have seen this. Let me just show you as I'm playing around here with this thing. So here's our little back test model that we're doing. So example, let's say that the price of TQQ, now I'm only in 2014 here, right? Y'all help me remember 746. Let me put it over here where I can remember to fix this back, but I'll just show you how this works. 7.46. Okay. So let's say you're just going to check this once a month. You know, Matt's working at home. He's working. He's going out with the track people. He's doing all this stuff. And all of a sudden, what you own at 746 in 2014 goes to $5. Oh, you're going to experience a loss, right? But you don't care because it's an opportunity to buy 1,629 shares. So that the spreadsheet tells you how many to buy. So then you go over here, name activity, and you log your purchase. You know, you go plus, not minus. Minus is sale. You go plus, end of the date, end of the price that you bought at TQQQ, and put no here. And then you come back and you log your net lick, right? And then you wait for the next thing. So then all of a sudden, what if that $765 goes up to $8? You're going to sell 534 shares. Well, if it goes up next month to $20, you're going to sell 4,156 shares. Do you see that? Lucello's aim tells us to take some off the top when price goes up. And it also tells us to buy, load the truck up when price goes down. So now we've got all the whole universe telling you and me you can't hold TQQQ long term. But I think we can. Now, why are they telling you you can't own TQQQ long term? Well, here's the volatility decay that they talk about in the TQQQ. So let's say that your account value in TQQQ, let's say you got $100,000 worth of TQQQ. That's all in stock. And let's say TQQQ, let's say the QQQs go down what? 3.33%. So you're going to go down 10%. So down 10%, negative 10%. So your stock goes down to $90,000. Everybody with me? Okay, here's what they're talking about volatility decay. So now let's say that QQQs go up 3.33%. So you're going to go up 10%. Well, now going up 10% will have you at 10% of 90,000 is 99,000. So you're at 99,000. Everybody see that? So a move lower took you lower than it doesn't, you're not restored. So you're going to have a bigger up move to get restored, you know, more than 10% to get restored to your 100K. But I would dare say, what is your opinion on tech? Now, can you run this with Bitcoin? Probably. If you want to do something, if there's some way that you can gamify Bitcoin, and I don't know how, I'm not that familiar.
I think they've said they were going to do a new ETF, like a crypto ETF.
Yeah, crypto ETF. So when that comes out, maybe you want to, if you're thinking, hey, crypto is the next big thing, put it into the AIM thing to where you'll know when to get out and take some money off the top. And you'll also load up the truck and know how many shares to buy on the downside. Now, y'all know on my videos that we record and everything I do, I never put a disclaimer on there. I never say, you know, consult your advisor, blah, blah, blah. But y'all know that I care about y'all and I don't want you to lose money. I'm saying that if there's holes in this strategy, I haven't found it. If there are holes in the strategy, I haven't found it. What if TQQ, Q, and the Qs go sideways a while? Might you lose a little? Well, yeah. But over time, I think if you look at the sectors, technology is pretty safe component to go with. Let's just see. Let's see. Let's go companies in the QQQ. All companies in the QQQ. So this is who we're holdings and sector allocations. Let's see if this will show us. Number one highest rating. Show me the companies. Where the companies at? Sectors, companies. Let's see. Most innovative companies. Let's see if it'll show us there. Top 10 holdings. Okay, there's a top 10. There's 100 in the thing. Apple, Microsoft, Amazon, Facebook, Google, Adobe, PayPal, Google, NVIDIA, Tesla. It tells you the allocation that it makes up. Let's see, Invesco sector allocation. So you're basically riding information technology. Do we think that's going to be good? Do we think communication services are going to be good? Consumer discretionary, healthcare, consumer staples, industrial. So it's got a little bit of all of that, right? I want to see the all. Let's see. Where's the dang list? That 100 companies here. Let's see who's in there. Let's see. View holdings. You think it'd be easy to get. Here we go. 68 more rows. Here we go. Flip charts. Apple, Microsoft, Amazon, Tesla, Alphabet, which is Google, NVIDIA, Facebook, PayPal, Adobe, Netflix, Comcast, Cisco, Intel, PepsiCo. Buying Pepsi, y'all. What did I get to? Broadcom, Costco, Texas Instruments. Are they still in business? Honeywell, Intuit, Qualcomm, T-Mobile, Advanced Micro Devices, Starbucks, Moderna, Charter Communications. Bobby, are you getting any little bit of diversification there? Yeah, we are. How many companies we getting? We're getting 100. Look at these, y'all. Micron. You know, I mean, now, and the other thing that's great about this, eBay, Synopsys, Kraft Heinz, we're getting ketchup in the group. O'Reilly Automotive, Cintas. Geez, let me know what we got here. What's your 102? I thought there was 100. But you see the Peloton, VeriSign. I mean, now, what if one of these companies go bankrupt? What if one of these companies go out of business? This list is self-cleansing. So one comes off, another one comes on. What if Ross stores go? By the way, I went to the bathroom at Ross stores. I try to go when I'm on vacation and all of a sudden I like gots to go. I try to go into a store that men don't go into. And I didn't see a single man in a Ross store. So I'm in Ross and I'm using the cleanest bathroom on the planet. Beth sends me a text, "Are you okay?" Because I'm spending so much time in there. I mean, look at the different stuff that we're getting here. How do you think these companies are going to do over the next 10 to 15, whatever your investment horizon is? How do you think they're going to do? And if some go bad, let's say that this Fastenal, whatever that is, they go out of business, then they go off the list. And the next greatest, they go, and then the next greatest technology NASDAQ company comes back on. Ta-da! Self-cleansing. You and I don't have to worry about stocks. We don't have to worry about reallocations. We don't have to worry about sectors. We just put our money on black and let it ride. Now, are you going to do this with Mama's money? No. You're not going to call Mama up and say, "Hey, Mama, we're going to roll it all on." This is risky. Keep in mind, without us having the Black Swan hedge in, there were times, if you're going to do this, that you had a drawdown of 49%. But what I'm also saying is, look how safer that AIM has allowed us to be. Because, I mean, now I'm going to try it with the rebalancing. I may just go forward and start rebalancing every year. So we went from 49, how many did we have? Let's say it one more time, in case somebody got in late. We started out with 46,000 shares. We started out with 46,000 shares. You're up a flipping 227% in 3 years. And instead of 47,000 shares, you only own 7,000 shares of stock. Matt, are you excited? That's like, yo, bro, you do it first. I will. But I think this is a great thing. And I think you could do this on a smaller account. I think you could do this. You could really take risks with a smaller account.
Could you define your definition of smaller account?
Well, the cool thing is, Matt, look, let's just say
$5,000.
Yeah, let's say $5,000. How would $5,000 have done on the visualizer? I think you're going to do better, right? But let's say you start with, well, it won't let us do the 5,000. Let me do my start. Let me go back to, let's go back here. Let's go to back to this portfolio. So we're starting in 2010. And again, this is back testing, right? Include year to date. So yeah, and we start off with $5,000. And you're going to do, I mean, how would you like to start out, man? Are you going to be a little bit aggressive and go 80% TQQQ, or are you going to do 50%?
80%. 5,000 is not.
Yeah, let it roll, right?
An astronomical amount.
And the only reason, Matt, I would say to keep 20% is you won't cash if it goes down. That cash is what you're going to use to buy more. So at your age group, I mean, you want to own as much of this as you possibly can. So let's say we start you out at 80%, and we're going to do cash X at 20%. So how would you have done up to today, right? If you had not used them. Now, AIM is going to make it much more safer because it's going to get out of shares as it goes up, and it's going to get, but let's see how this portfolio would have done. Okay. So, Matt, if you started in 2010 with $5,000 and just buy and hold, y'all. Now, keep in mind, they tell you and I, and maybe they're smarter than we are. Maybe I'm missing everything. Maybe I'm just missing everything. But you would now be holding $211,000. 41% standard return. 1 year you would have made 111%. Your worst year would have only been negative 15%. Your max drawdown, check that out, is negative 41%. You got a pretty good Sharpe ratio. You got a higher Sortino ratio. your correlation to the market is even less than 1, right? You would think with TQQQ, you probably got a US market correlation of 2 or 3. Once it's 80% this, 20% cash, you're there. So you're up 41%. Look at this. Now, on the year that you had a maximum drawdown of 41%, there's a good chance if you're edging into your black swan hedges, that picked you up. So you didn't have that drawdown. So you've done better, and you probably either have more or less shares, probably less shares than what you started out with in 2010, because as this goes up, what happens? You are getting rid of shares and converting it to cash. Why do we want to keep the cash? Because we want to back the truck up when this thing goes to 0 or 99% down. Could you imagine what would have happened if we had bought in 2020? Let's see what it looks like. I don't know how this would look. Can you imagine if you had, after the March crash, if you had, put $5,000 in 100% TQQQ? I'm hoping it's going to show me through today, not just 2000. Put 100,000%. Oh, not 1,000%, Bob. I'm using Auburn fan math. My apologies. I mean, think about it. Your rate of return, if you put in 5,000, Matt, March 20, when everybody was screaming, "Oh God, the market's going to 0," and you'd be making 82%. Your best year was 110%. Your worst year is 37%. Max drawdown of 49%. And that's even, it started at the beginning here, right? Here's where you had the big drawdown. Can you imagine if you had started here? Look, your $5,000 went down to $2,752, you idiot. That's what your wife would be saying. That's what Beth would be calling me. She said, "You stupid idiot. You put in $5,000 here, Dorcas head. And now you lost me $2,248. Shut up." But oh my, it would have gone. Now look, so here I am, I'm buying here. Look, I'm buying in a deal. I bought my 243 shares on a little bit of a deal. Isn't that cool? Anyway, I think this is a really, really strong thing. And go to Portfolio Visualizer, play with it. I think this is a great tool that helps us a lot. I've seen a lot of people post on this, but to leave it to a vacation that gives me a little bit of time to play and to think and to do. I spend a lot of time on there. And then I'm going to take this to the closing. It may take me a while, but I want to take this from 8/11/14 to see how we did. And I'll probably, at the end of 2014, I'll probably start rebalancing. Right. But I mean, how cool, man. This is pretty much a sit back and relax portfolio. Let it do, what you want it to do. But I don't know. I'm really, really excited about it. Yeah, can you please remind me where the AIM spreadsheet with rebalancing is? Okay, here's what I would say. Why don't I share this one with y'all today? I think that's what I got to do. I'll share this one with y'all. Hold on, I think I can do it right now. My drive. TQQ back test monthly. Yeah, this is it. And it's got all the updated formulas, and it doesn't take the governor into account either, right? So I took the governor out. Let's see how I share this. Get a link. Share. Anybody with the link should be able to open. Get link. Restricted. Only people added can open with this link. Change to anyone with the link. There. Get link. Copy link. And let me share it in our little chat here. Where's my Google? Here we go, in our little chat. So everybody can get that. We should be able to access that. So, we're always trying to build a bigger mousetrap. We'll see. What if the market's down 20% tomorrow and, I blow up? So I was kind of like, I don't know if I need to share this with y'all. It seems kind of risky, but you got to trust the methodology. You got to trust, hey, when the market goes down, that's a great time to be buying shares. Now, if you'll have that mentality, you will do well with these. Now, if you have the mentality, oh my God, I'm down 50%. My life is over, and you're going to go jump off a building at the Piggly Wiggly. No. Don't put mama's retirement money in this, but I think you could do 10,000 or 5,000 in this and be perfectly fine. And do our hedges, right? Do our hedges. Heck, if you don't do the hedges, it looks like the back test is really, really good because you're taking on so much risk, less risk than a buy and holder. Oh, it's just sweet, sweet, sweet. I was really excited to share this with you guys. All right, questions, comments. And Ken, thanks so much for leading the sessions last week. I know it was great.
Oh, you're welcome.
Ken, what do you think about this?
Honestly, the only thing that worries me is we've been in a raging bull, so we're only seeing one side. When I was back testing AIM when we first got a hold of the book, I would go back and deliberately look for sideways markets and markets that had down movements, and in a couple cases we went bust. And I even adjusted one account, 1 to 2% stock and 98% cash, and it still went negative. That's why I like your governor idea, because that could have been maybe possibly prevented. So I'm a little concerned that in this wonderful market of ours, that that's always a perennial bull, that this can't go wrong, but that's just, I've seen bad times, and you're old enough yourself to have seen bad times too. But the truth is, as long as we got this government spending and inflation, we're going to have a bull market. And technology makes for bear markets because it makes things cheaper. We have new tech coming along left and right. So I'm actually thinking I'm going to devote a portion of the big IRAs to doing this with the TQQs, or just the these leveraged ETFs, because you've shown it works, that it's not as dangerous as everybody says. I would diversify your portfolio, analyzer notwithstanding. Just diversify a little bit, and just for safety.
Yeah,
and,
sure. And I'll tell you what I did, Ken. Hold on a second. Speaking of diversification, I did do diversification. Let me add this. So instead of here's what my plan was. My plan was, so let's say you take a $50,000 account, and you say, okay, I'm gonna put into underlines, like TQQQ, I'm gonna put $40,000. So then what I did is this. I said, okay, but I'm only going to put 90% of that into TQQQ, which effectively is 76% or 72% of the 50,000, right? Now, what did I do with the other 4,000? With the other 4,000, I put it into a little thing called TMF, which is the
bear version,
the bull version of the 20-year treasury, to give just a little bit of bond exposure there. So 72% of the account is in TQQQ, and 8% of the account is in a little bond fund, just kind of smooth it out. Fortunately, they're both up. So I did this Friday, right? So Friday, look at this. This one is up $33. And I know it's 2 days, right? But my TQQQ thing that I put in on Friday is up $834. Now, there's a likelihood this will be down 4,000 at some time, right? But what is AIM going to do? AIM's going to say, bye, 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 Bobby. Bye. Load the truck up. So I'm happy with letting this little AIM thing run here. And what do? Well, you still do your 1-1-1s. You still, if you want to, you still do calendar spreads when appropriate, right? To give you a little bit of negative deltas. The 111s is the greatest trade on the board, I swear, that we have. So keep running those. I don't know if you need to do the, since you're so bullish, well, look at this. Look how bullish my deltas are. I don't think that you have to do the micro short push, but certainly you can. See my deltas, I'm positive 157 here, right? So most of that's coming from the TQs, which is 254. So I've got some things that are giving me a little bit of negative delta here that are kind of hedges, right? And I don't know, it's kind of cool though. All right, well, guys, you guys have a great day. I think this is definitely a recording that we want to hang on to. I think this is kind of a cool little thing, and we'll see how it goes. And I hope y'all have a great rest of your day. See y'all later.